People feel a quiet sense of pride when they say, I invest in mutual funds. It feels like a responsible step, a grown-up decision, a sign that they're finally doing something right with money. And in a way, they are. But here's the truth most people don't want to hear. The majority of mutual fund investors never become wealthy. They invest for years, sometimes decades, and yet their life doesn't really change. They still worry about money. They still live paycheck to paycheck. They still feel one crisis away from financial stress. Not because mutual funds are useless, not because investing is a lie, but because wealth is not created by investing alone. For many people, investing becomes a ritual. They start a monthly contribution. They automate it. They stop thinking about it. They believe consistency is enough. But consistency without awareness is just habit, and habit without growth leads to stagnation. One of the biggest mistakes people make is starting late. The early years of adulthood are spent upgrading life. Better phone, better clothes, better lifestyle, small comforts that feel harmless in the moment. Investing is postponed. Later, they say, when income increases, when life becomes stable. But stability rarely comes first. Pressure does. By the time people start investing seriously, their best weapon, time, is already weakened. Another mistake is investing what feels safe instead of what matters. People invest small amounts because large ones feel uncomfortable. They want progress without sacrifice. They want financial freedom without changing behavior. But wealth is built through uncomfortable consistency, not comfortable contribution. Small investments protect you from collapse. They don't create transformation. Then there's the issue almost nobody talks about. Income stays the same while expectations grow. People focus obsessively on returns, percentages, and fund performance, but ignore the most important variable in wealth creation, their ability to earn more. If income doesn't grow, investing becomes a defensive move. You're not building a future, you're just slowing down decline. At the same time, lifestyle quietly expands. What once felt luxurious becomes normal. What once felt optional becomes necessary. And suddenly, investments are fighting inflation, expenses, and emotional spending, all at once. Another silent killer is emotional decision-making. People say they're long-term investors until markets test their patience. When prices fall, fear takes over. They pause contributions. They wait. They want certainty. But certainty is always most expensive. When markets rise again, confidence returns, and people invest at higher prices. Over time, this behavior erases the very advantage that long-term investing is supposed to provide. Then comes a deeper misunderstanding, confusing tools with outcomes. Mutual funds are not wealth. They are not freedom. They are not independence. They are containers. Wealth comes from what fills those containers: income, discipline, patience, ownership, and long-term thinking. Most people never build anything outside their investments. They don't build skills that increase earning power. They don't build systems that create income. They don't build ownership in anything meaningful. They place all hope in one financial product and expect it to change their life. It won't. Another pattern is subtle but powerful, investing last instead of first. Money flows into lifestyle automatically: rent, comfort, entertainment, convenience. Investing gets whatever survives the month. Wealth is built when this order is reversed, when investing is treated as non-negotiable, when lifestyle adapts to what remains. This is not about restriction, it's about intention. And finally, the most common reason people stay poor: they stop too early. They expect visible results in a short time. They want proof. They want motivation. But compounding is quiet, slow, almost boring. For years, it feels like nothing is happening, and then, slowly, momentum builds. Most people quit before they reach that phase. They mistake patience for stagnation and boredom for failure. So they exit and start over, again and again. And then they say, investing doesn't work. It does, just not the way they practiced it. Mutual funds will not make you rich on their own, but they can protect you from desperation. They can provide stability. They can support long-term security. True wealth is built when investing is combined with higher income, controlled lifestyle, emotional discipline, and long-term commitment. If you understand this, you're not just investing differently, you're thinking differently. And that difference changes everything.